Okay, so class 5. All right, so what we're going to do in the class is I have probably, I don't know, 40 slides or so with content in terms of lecture material, and then a series of very simple examples built into the slides. And then there's, I think, 4 class exercises. I would be surprised if we had enough time to go through all 4. But we'll try to get through at least 2 of them, and whatever we don't do tonight, we'll do as homework, and we'll go through them next week. And if you're wondering if this is going to be on the exam, it'll be on the exam.
Wonder no more.
Yeah, wonder no more. It'll be on the exam. So we're going to start by going through just the different types of options. Okay, so forget accounting for a few minutes, and let's just talk about stock compensation in general. So people come to this class with a variety of backgrounds, and sometimes when I start in this material, I've started too quickly in the accounting and realized that once we get to examples, people are asking basic things about what the equity comp even is, and you can't really appreciate how to do the accounting unless you know what we're talking about factually. So we're going to build kind of some awareness on how these option and restricted stock arrangements work. Okay, so this slide is comparing ISOs and NSOs. Okay. So ISOs, incentive stock options. So the idea behind an incentive stock option was, boy, wouldn't it be great to incentivize an employee to get this equity instrument, and if the stock went up, that they could be treated as basically receiving capital gain income, as long as they were basically invested in the company like any other investor would be. So the idea would be, you get a stock option, okay, and let's say that the stock price is 33 bucks in Ann's case, and so what the company would do is they would say to her, look, if you keep working here, we will allow you to exercise an option to buy our stock anytime in the next 10 years at a price of $33 a share. So Ann's hoping that hopefully the stock will go up, and that in the future she'll pay $33 to get a share of stock that is worth more than $33. Okay? And whatever the difference is, that's the economic gain she's hoping to get. Okay? With an ISO, the idea is, let's say the stock goes to 43, like we said a few minutes ago. If Ann exercises and then keeps holding the stock for a while, like any other investor would, so if she holds on to the shares that she got through the exercise, then the tax rules will basically say, you know what, we're not going to tax you on that like it's wage income. We're going to tax you on that whole gain as if it's capital gains, like you're an investor. So of course, Ann's thinking, that's great. My tax rate for capital gains is lower than my tax rate on wage income. So I might just want to buy the stock and hold it for a while, and then my gains will be taxed at a lower rate. Right? That's the theory about the appeal for ISOs. Okay? So Ann, if you got an ISO with a strike of $33, meaning a strike price, and the stock went to 43, and you decided to exercise, would you hold that stock or would you sell it? You would sell it. Okay? So Rochelle, if you were in that situation, would you hold it or sell it? Okay, Rochelle says hold it, only because somebody hasn't told her why she would sell it. Okay, so Ann, why would you sell it? It's cash right now. Well, there's 2 things, right? One is, when you exercise an ISO, the $10 of unrealized gain in that stock, that's income for AMT purposes. Okay? If that income is big enough, that creates problems, right? And a lot of people in California pay AMT because of the interaction of state tax deductions, right? So even though you didn't get any cash, you might pay AMT tax right away, and that doesn't feel good. And in fact, what happened in the dot-com boom was, let's use a more exaggerated example. Let's say that they gave on an option when the strike price was 3. The company was just formed, it was new, and then it went to 43. So on exercises and has a $40 AMT pickup, right? And that might be huge, right? I mean, let's say you make 100 grand a year, but you had 400 grand of AMT income because of options. That happened to a lot of people. So then they went off and paid AMT tax, right? Let's say they paid $100,000 of AMT tax. And they're like, no worries, that's good. I'm still going to be so rich, it's going to be great. AMT is a minor problem, right? And so then what happened with the bust, right? The stocks all went back down to 3. So then somebody in on situation just paid $100,000 of AMT tax, but didn't get any cash from the stock, and now the stock is worthless. So you basically just paid the government money. That's, at the end of the day, all you did was pay the government tax. So that's bad, right? And so what employees started to realize is that by holding the stock and paying AMT in the meantime, you're really gambling, right? You're gambling that the stock is going to at least stay there, if not go up. And you know, that's one thing to just gamble on like the hope it'll go up and down. It's another thing to pay a bunch of tax to the government and be committed and not ever be able to get that tax back. And that's what happened to a ton of people in the bust. So no one holds ISOs anymore. Okay? Grant.
What about selling a number of shares at that point in time to cover your EMT costs, like cover your taxes, and then moving on to the rest?
Well, it's possible. I mean, as a practical matter, what happens is, so on does Sandus give out ISOs? Guarantee you they don't. Rochelle, do you have ISOs? Who else works for a company? I'm guarantee you, like, none of you get ISOs. Yeah, different. And the reason you don't get ISOs is because when employees had that fallout with the love affair of ISOs back in the dot-com bust, companies are like, you know, we don't want unhappy employees because the stock screwed them from their own personal tax situation. Like, that reflects badly on the company, and we're trying to do a good thing. So we're just not even going to offer it because it creates so much confusion and hard feelings and complexity, and it honestly doesn't help our tax situation from a corporate perspective. We're just not going to do that anymore. So you see ISOs with small companies that are private, that are newly formed, but you never see it with big companies anymore. It's for that reason. Okay. So you see on the bullets, if you just go back through that, possible AMT at exercise, but long-term capital gain if you meet the holding period. Okay, so that's all true, but everything I just said about the practical side of things, that's more true. Okay, it's just hard to write that in a series of bullets.
Isn't there a Section 83 election that a company can make where you just recognize the gain immediately?
Hold that thought and I'll cue you later, but the answer is no on this slide, yes on another slide.
I'm lost a little bit in the sense of if you exercise an ISO, don't you cash out stock? You don't.
If you exercise an ISO, all that it means to exercise an option is you pay an amount to a company and they give you stock in return. Whether you then decide to sell the stock, that is another decision. And if you decide to hold the stock to try to get this capital gains tax treatment, that's a decision that's separate from the exercise. Okay. For now, just know that ISOs, if they met the holding period requirements, it would be beneficial for the holder, and the corporation would never get a deduction. Okay. All right. Non-qualified stock options are really what you think about when people just say options. They usually mean non-qualified options, or NSOs. So if On gets an option to buy stock at 33, and she's got to work for a couple years to be able to be vested in that right, and hopefully the stock goes up and she exercises, whatever the unrealized gain is when she exercises, that gain to her is compensation, and that compensation is deductible by the employer. Okay? And now, if On paid Sandus $33 for a share of stock, and she picked up $10 in her W-2, her basis in that stock today is 43. right? So, if you got an MSO and you paid the $33 and SanDisk says, here's your share of stock, do you sell it or do you hold it? Yeah. Well, you would sell after you exercise. Why would you sell? Right. So that $10 of income that goes in her W-2, SanDisk is going to say, hey, that's like wage income. And you know how I withhold on your wages? I'm going to go ahead and withhold on that 10, so why don't you give me some money? And On would say, in case you haven't noticed, I'm not like growing tree money in my cube, so I'm going to need to somehow get money to pay you for the withholding, right? That's how it works. The other thing is if the stock goes down, if it goes down to 41, then On has a capital loss of $2. She probably doesn't want a capital loss of $2. If she wanted to speculate on if the stock was going up or down, she'd probably just wait to exercise, right? I mean, usually when you exercise, that's the same decision as you saying, I'm done, I want my cash now, right? Okay, so for NSOs, whatever the gain is when the person exercises, that gain goes in the W-2 just like it's cash wages, subject to withholding, and the company gets a deduction. Yeah? All right, that's ISOs and NSOs. Okay, ISOs and ESPPs. So we've already talked about ISOs, so let's talk about ESPPs. So ESPPs work kind of like ISOs in that they're meant to be an incentive. And you can see that there's this limit. And there's also this discount. These are the kind of the key terms here. So let's use rounded numbers. Let's say that let's say that Man works for a public company and the stock of the company is worth $10 a share. Okay? What that company can do is say, you know what, we would love for you to be a partial owner in this company and feel like you're a shareholder, but we know that's hard, right? Not everyone has tons of money. So we're going to give you the ability to buy stock in the company, but at a discounted price. And if you meet certain holding period requirements in the stock, it can still all be capital gain to you. Okay? So we'll give you the right to buy the stock at $8.50 instead of the fair value at $10. And we won't even tax you on that built-in gain of $1.50. We won't tax you as compensation if you meet certain holding period requirements. Okay? But we're only going to let you participate to the extent of 25 grand a year. So if Minton said, you know what, that's a great deal. If I'm going to get a guaranteed 15% return, I'm taking the Min family fortune and I'm going all in on that, right? So the rules are like, yeah, not so fast. We're not here to like, create a big old tax loophole. We're here to create an incentive for you to participate in the equity ownership of a company. But what we're trying to do is incentivize a broad group of people to all be shareholders because we think that's a good thing as a government from a policy perspective. Okay? So for people who have ESPPs, like Janie and Rochelle apparently, do you participate in your ESPP, Janie? Yeah, and you do probably because you get a discount, right? So you're like, how can I lose, right? And the way ESPPs generally work is they'll say, like let's say it's a calendar year, they'll say, you buy at 85% of the lower of the price on January 1 or December 31. So you can only win, right? If the stock went from $10 on January 1 to $15 on December 31, they're like, pay us $8.50 and we'll give you stock worth $15. Right? And if the stock went from 10 down to 6, they'll say, well, we'll sell it to you for 85% of 6. So no matter what, you win. So it's a great deal. Usually everyone participates in ESPPs because you just can't lose. So the problem with ESPPs, much like ISOs, is that if you meet certain holding period requirements, it's capital gain income to the holder, which means there's no corporate tax deduction to the issuer. Okay? And I guess my theory on ESPPs is, I don't know if it's a well-educated theory, but it feels like most people actually meet the holding period requirements for ESPPs. So, Janie, when you get your ESPPs, do you hold the shares?
So the first time I bought low and then the stock went up, so I sold. But right now I'm working on my long-term capital gain.
So the answer is some of both for you.
So yeah, it really depends. But yeah, you win either way.
Well, sometimes I feel like people even hold the stock after that period is over, just because I think they like forget about the stock because it's pretty small, and it's just always pulled out of your paycheck on like a monthly interval, almost like it's your health insurance. So
Feels like a savings.
yeah, so I think a lot of people meet the holding period accidentally, oddly enough. Grant.
Yeah, it's interesting though, because I mean, I played this game a long time ago when I worked inside of Airline. You don't get that. It's actually, I think, equivalent, comes out to more like about 18%, 17-18% increase from 85% to 100%.
Yeah.
But you're only guaranteed that if you do a same-day sale.
Yeah, that's right.
And
Right, because if let's say in my example the January 1 stock was 10, December 31 it was 15, and so they basically say at the end of the year you can buy that stock for $8.50. If you don't sell on December 31st and the stock on January 1st of the next year goes down to 12, you're not making as much money anymore, right? This is now your money, you're losing now.
I think people need to be thinking about, like, do you really want to own this much of the stock? Would you rather diversify across something that might be better?
Right.
Compared to having all your eggs in your company.
Grant's like our resident investment advisor.
Stock. Oh, I had stock. And
Grant's like, you got bonds, you got stocks,
up to 200,000.
You got your retirement funds. Meet Grant after class. I don't even know if we're like a you, but
But
we need to have like a Fidelity booth over here today. Yeah. Yeah.
Question, isn't that related to the SBPR stock option? How about the gift cards? Before I receive gift card from the company, like also...
Totally outside of the scope of this class. I'll talk to you about it at break. Okay, ESPPs, a lot like ISOs, 15% discount. A lot of companies give them. The trend in the recent few years has been for companies to pull this policy. So the fact that like NetApp gives ESPPs, that's them being nice. Does SanDisk give ESPPs on? They do. Linda, did Oracle give ESPPs when you were there? Really? Wow, lots of nice companies in the room. The reason that companies don't give ESPPs is that the book rules for how to determine how much they're worth for expensing purposes, it's kind of punitive. So it costs the company a lot in terms of the expense that they record, more than maybe you value those awards. Because what you're basically saying is this ESPP, this option, this right you have, it's already in the money. So that looks pretty valuable. And the book rules say we're going to make you expense that in the money value plus the speculative value of the stock even going up further. And so that's a big nugget for companies to bite off from an expense perspective if they're focused on earnings per share. I mean, it's all non-cash, but from a P&L perspective, companies don't like that. So a lot of companies have pulled back their ESPPs, or they'll say things like, well, we'll give you the ESPP, but at no discount, which I think is always funny because you could call your broker and buy stock any day of the week. So it's really the monthly withdrawal, and some people just need like forced savings, I think, to make that work. Okay, that's the ESPPs. Okay. Okay, so if you have an ISO and you meet the holding period requirements, that's what's called a qualifying disposition. So in the case of a qualifying disposition, there is no nothing reported on the W-2, and the company gets no tax deductions. We already talked about that. In a disqualifying disposition, so if you exercise your ISO, and then right away you're like, I'm selling this stock. I want my money. I got to get out. Then if that's the case, then you're really treated almost the same as a NSO, where that gain you have, it's ordinary income. It's like wage income. Okay? So they're basically saying, look, if you don't want to play the game, if you don't want to be an investor, you don't want to hold shares, we'll just treat you like you're an NSO. That's what most people do. I would guess 99% of ISOs out there with public companies get exercised this way. And it's people not wanting to get whipsawed on the AMT and the stock going down. That's what it is. Okay, that was options. So I'm just going to pause for a second. Questions on options before I get to restricted stock?
If I sell my rights to somebody else, like a third party, is it income to me? Or?
Timmy, you're like the creative guy. You and Grant could get together and you guys can be in business. So if you sell your rights, most companies' option plans will not allow you to sell your rights. There'll be exceptions to that where, like Facebook was kind of famous for this. They were allowing employees to sell their options into a private market, basically to accredited investors. So for people in Facebook that wanted to monetize early, they could before Facebook was even a public company. But most companies restrict that. They make it very straightforward that you exercise an option, you get the company stock, whatever you do after that is your business. But other than that, they don't really play lots of creative games. And mostly, I mean, if you put yourself in the company's shoes, they don't want to be accommodating everyone's little twists and turns. They just want a nice set of rules that everyone plays by. Anything else on options? No? Okay. So one thing that you should be taking away from this is, gosh, when back in the 90s and 2000, when the stocks were going like through the stratosphere, like what was happening to companies from a corporate tax perspective? Huge deductions, right? Tax deduction. There was no such thing as book expense back in the 90s. This is a new thing. So take like Yahoo. When I started working on Yahoo back in like 2005, they had around $4 billion of NOLs, all from stock option deductions, because Yahoo's been profitable since like forever ago. But on their tax return, they had gigantic deductions for stock comp because their stock used to be over $100 a share. I mean, it's like 15 now, but when it was 100 and people were just shoveling money in the door, the company was like, I get a deduction for that, I get a deduction for that. And you look at the tax return and the book tax difference for option was like giant deduction, right? So like when Google went public, same thing, right? I'm sure Apple's deduction for stock options and stock compensation is like crazy. When you look at the stock deductions for AMD, you know, not so much. So it's a little feast or famine, right? But you can imagine successful companies where their prices have been going very high. That means there's very big deductions for stock compensation.
Okay, about NSOs. The literature talked about them being DTAs. Is that because I know they get a tax deduction at the time of exercise, and that deduction is going to be greater than, I guess when I'm
Well, hang tight actually, because I'm going to answer your exact question.
I understand the deductions from the tax side, but the deductions from the book side is what I'm driving at here.
I'll get there in a minute. I'm getting there. Okay. Anything else related to the tax treatment of options? No? Okay. Going. All right. Restricted stock. Okay, so options became less popular after the rules for expensing stock options or stock compensation came out. So those were called the FAS 123R rules. And those came out effective in 2006. And basically what the FASB said is, look, before 2006, as awards were given to employees, as long as they weren't in the money, we're going to say there's no value to them for accounting purposes. And so back when Yahoo was in its prime and the stock was super high and those deductions were huge, there was no book expense because they were saying, well, here's an award, it's at today's price. If it goes up, that's great, but today it's worth nothing, right? If you think of it as an only today thing. So the book accounting rules would say, hey, as long as you're giving out awards that aren't in the money, we're not going to make you expense anything. We're going to say there's no value there. And so companies were like, this is awesome. We can give stock compensation to employees. They love it. We don't have to expense it. We can give them more. They'll want to work for us. We still don't have to expense it. And it's just win-win, right? It's just fostering all this growth. And that's what the, Cisco was a big advocate of keeping that existing regime in place. And they were like, this spurs growth, right? This incentivizes people because companies want to do it, employees want it, everyone's happy. And then when the rules came in and they said, you know what, that stuff has value, we want companies to expense it. Well, now all of a sudden it looked like on the income statement for companies there was this large expense. And it kind of makes companies look much less profitable than they would otherwise look. So that's not great, right? And a number of companies would say, okay, fine, here's our GAAP financials with this stock compensation in it, but let me show you my financial statements without this too, because we think that might be another data point you want to look at. So companies would do it both ways. And they would say, these are my GAAP financials with the expense, but I'm just going to show you non-GAAP too. And I know we talked about that in a prior class. But stock compensation was really the driver of that. So the reason that options became a lot less favorable is the FASB rules require you to value an option based upon its fair value. And so if I said to okay, I'm going to give you an option to buy SanDisk stock at $33 anytime in the next 10 years. But I'm not going to just give it to you. I'm going to sell it to you. So what would you pay me for that? Well, no, I'm going to give you an option to buy in the future stock at $33. So what you have is this right that if the stock goes up, that's this great thing. And if the stock goes down, it really doesn't matter. So that ability for you to profit from the gains but not suffer the losses, that's that option value, right? So what do you think that is worth? Like if you really wanted to pay for that today, what do you think that's worth? What do you say, Tim? Timmy says 50 cents.
Well, you don't know until you look at what the...
Well, how far out is it?
So normally, are yours 10 years? That's normal.
So you have the option to buy a company.
Anytime in the next 10 years, you could buy the stock whenever you feel like it for $33 a share.
So I can buy it right now at 33. I can buy it tomorrow at 33. I can buy it a year from now, or whatever. It could be at 40.
Yeah.
It's probably worth 30, more than 30.
The question is, are they going to damage the stocks?
So stop for a second. So like An's sitting there going, Grant, you're out of your mind, right? So Timmy thinks that that's worth 50
What
cents.
is the stock worth today?
The stock's worth 33 today.
Okay.
You can make a bad thing.
What, you know?
You're buying the stock at $33, right? I still have to pay the additional 33 to buy the share.
Right, but what if the stock went to 93? What if SanDisk was the next Apple? Then that option to buy stock at 33, you're like, I want as much of that as I can, right? I'm going to pay top dollar for that. And if you were like sure that SanDisk is coming out with the next iPad and no one else knows it but you, you're going to be like, I'll pay whatever you want me to pay for that option, right?
Well, it'd be worth the difference between 33 and 93, discounted for the cost of money for that time period.
Right, like if you were sure, you'd say, gosh, I will discount 93 back, and let's say that that's 73, so I'll pay you $40 for that option, right? Because that thing is gold. But a lot of employees,
33.
right, a lot of employees would be like, it might go up, might go down, I don't know, it's worth 50 cents, right? That's
Out of the air, right?
I mean, that's a common perception. And so the problem that companies have is, well, they're expensing this big number based upon real math and formulas based upon volatility and these kind of independent characteristics of a stock when employees are making emotional decisions about what it's worth, right? So when Ann shakes her head at Grant, she's not saying because, I've done the math and the modeling and it's not worth that much. She's just like, I don't believe it, right? And I realize I'm putting words in Ann's mouth, but I'm pretty comfortable with it.
Well, would she be willing to pay $33 to buy that stock today? She'd probably say no.
Probably no, right?
So I have to pay the $33 in order to get the stock, and that's what I was able to. So I'll pay a lot less for the option, the private option.
Well, the differential.
Yeah.
Yeah, for that, I'm just saying as far as the actual cost you're willing to pay for that share of stock, plus whatever.
Well, if Ann wanted to be a stockholder, she would buy stock today, right? She doesn't want to be a stockholder. She wants to be compensated as an employee, right? And so most employees think of stock as like gravy, right? They're like, give me my salary, stock is gravy. But the way the accounting rules work is they make you expense that stock based on what its value is, and the value that companies have to expense, it's computed basic by, finance guys who are doing this in a very unemotional way. They're saying, like, take Apple. They would say the stock's been going straight up. It'll probably keep going straight up. It's always been going straight up. So we'll build that into our valuation model. And the amount that Apple would have to expense for an option would be very high, right? But there might be employees at Apple who are like, it might go up, so I'll just think of that as gravy. And that disconnect makes options very unpopular because companies are expensing a lot more than employees perceive value, and that doesn't feel right. Right? If I expense $1, I want you to feel like you just got $1.
But the issue with an option is that you actually don't have anything in the end. If you don't exercise it, you don't have anything. So that's not like they don't have the stock.
Right.
Therefore, trying to be willing to pay a little
I think for
better.
every dollar you spend, probably is not a fair value to the employee. It's not dollar for dollar.
Right. And so most of you have probably heard of the term Black-Scholes. So companies generally use Black-Scholes, which is a formula for figuring out what the value of a stock option is based on all these inputs. And a lot of people would say, oh, that number's crazy that Black-Scholes comes up with. But it's based on trends and volatility and the performance of the stock, and it's meant to be very objective based on data. But you'll sit there and make your own opinion about a company's share price, and Black-Scholes does not factor in your personal opinion, right? It's different. So anyways, because of that dynamic, restricted stock became a lot more popular. And so the way restricted stock works is, like, I could give on 10 options to buy SanDisk stock at $33, or I could give her one share for $33 worth and just be like, you know what, you just keep the share. I'm good, right? You're all set. Even if the stock doesn't move an inch, you still make $33.
When it's actually switched, recently earlier this year, switched from a non-qual plan to an RSU.
Right, and so it's exactly for this reason, because if I said look, you can have 10 options, you can buy 10 shares of stock in the future for $33, or I'll just give you one share today for $33, what would you take? On would take the guaranteed one share, right? And so that is basically on saying, you know what, I could make $33 in the future with my 10 options if the stock only went up $3 a share, right? If the stock went up $3 a share and you have 10 options, you'll make $3 a piece on each. That's $30. So she's saying that in the next 10 years, I don't think the stock is going up $3.
Right.
Right? That's how everyone thinks. Because it's a bird in the hand, right?
She's got $30.
Right. So companies are like, okay, you're happy getting 33. We are also happy giving you 33. And we love even more the fact that when we give you 33, you feel like you got 33. Right? So now tons of companies give restricted stock. They don't give options because of that employee dynamic. Okay?
So on taxability to the employee, are they taxed the same? For instance, are they
So we'll get to that in a second, but I want you to understand like why there is restricted stock versus that's not good. I want you to understand why there's restricted stock compared to options, because I think people always hear options out in the valley, but options don't exist much anymore because what you guys do, and Rochelle, do you have RSUs or options? You just have ESPP?
I do SJSU.
You guys have RSUs. Yeah, so that's pretty common. Like Amazon, I don't think they have options. I think they only have RSUs. I mean, I'm sure it would say in their 10K, but I've only ever heard of RSUs. Unless it's like an acquired company or something like that. So that's very common. Okay, that whole background makes sense? Okay. All right, so with restricted stock, okay, there's two types of restricted stock. There's what's called RSAs and there's RSUs. Okay, so They're very similar, but there's a subtle but important difference. Okay, so the first slide we're going to talk about is RSAs. So the way an RSA works is I give you a share today, and I say, here, Gamma, here's a share of stock. You own it. Good for you. Hold it like you would any other share of stock. But guess what? If you don't keep working here for a period of time, I'm taking it back. Okay? So it's bless you. It's a restricted stock award because it's stock. You get it, but it's restricted because if you don't do what I say, then I take it back. Okay? And the way that restricted stock is taxed, it's taxed based upon the fair value at the vesting date. So if on the day it vests it's worth $33 a share, Gamma picks up $33 of income, the company gets the $33 of deductions. Okay? So the alternative, which is what Michael was talking about a while back, was when Gamma gets that stock, he can make what's called an 83B election for tax purposes. And he can say, you know what, when you give me that stock, right, let's say it's worth $10 today, I can just pick that up as income today instead and say, well, that's immediately taxed. And I'm such a believer that the stock is going up that on any future appreciation, I would rather that be taxed as capital gain. So tax me today on today's value, and in the future when it goes up, I'll be taxed at capital gain rates. And On would say to Gamma, you're such a fool because what if the stock goes down? You'll have capital losses. Why would you do that? And the number of people that get restricted stock and make 83B elections when the stock price is of any material amount is almost zero. And it's for that reason. If you go to work for like the next big thing company that just formed and has 5 employees and they give you restricted stock and the stock is worth 6 cents, well then you might be like, well, the upside looks pretty good here, so I don't stand to lose much, right? You can tax me on 6 cents and I'll bet that I'll make $100 and I'd like to save all that tax. So that happens all the time. But big public companies, you do not see this because people don't want to put their money in and make their bet. And a lot of companies don't even give restricted stock because they don't want employees coming to them and trying to make 83B elections and following it up and making life complicated. So they just want to keep things easy, and they're like, we cannot trust you, right? So no RSAs for you. That's very common. Did I change the video? I still should be going. What do you mean? Oh yeah, I'm still going. You're making me nervous. Okay, so that's restricted stock awards. Restricted stock units. Okay, this is economically the same thing. Well, very similar. It's a company saying to you, look, if you keep working here, after a certain period of time, I will give you a share of stock. And so you might say, well, gosh, that sounds a lot like me getting the stock and you just taking it back if I don't meet those criteria. It's kind of like 6 of one, half dozen of another type of thing. But with an RSU, you don't get to vote because you don't own the shares. All you have is a promise to get shares. You don't get dividends because you don't actually own the shares. You just have a promise to get shares. And you can't mess around with this whole 83B election because you can only make an 83B election if you have property. And a promise to get stock is not property. It's just a promise. So RSUs are the preferred equity instrument of choice these days because On's happy. She feels like she got her $33 and she's like, that's great. The company's happy because it only has to expense $33. It doesn't have to expense some speculative future value. On has taxable income when it vests and she gets the stock. The company gets a deduction equal to the same amount that On picks up as income. It's just like wages. Everyone's happy. Okay, there's no special tax benefits or anything like that, like an ISO or an ESPP, but it's very predictable and people understand it. And I think that's a big attribute with this sort of thing.
What's the valuation?
The valuation is just whatever the share of stock is today. So if I say to you, Gamma, I'm giving you stock and it's worth $10 today, I don't know what it's going to be worth in 2 years when it vests and you get to keep it, or when I actually issue the shares. But when I give it to you today, it's worth 10. So in theory, I'm telling you it's worth $10. There is no option element to it. The stock can go up or down. So it's worth today whatever it's worth. I mean, if the stock goes down to 6 when 2 years go by, Gamma only has $6 of income, I get a $6 deduction. So unlike an option, right? With an option, if the stock goes up, you make money. If the stock goes down, you don't care. With RSUs, if the stock goes up, you win. If the stock goes down, you lose. So there's no fair value in that RSU other than whatever today's value is. Because if there was another fair value, the stock price should be different. Right? It should already be reflected in the stock price. Does that make sense? Jay?
So are RSUs, are they only for public companies? Because I guess privates wouldn't really have that.
No, privates can have RSUs. Yeah, I mean, all an RSU is, it's a promise to issue you stock once you meet certain criteria.
But then for the value, would they just have to get the evaluation for that day?
So that's a very good question. So if you're a private company and you issue stock, how do you know what the value is? And the answer is you got to get a valuation. And there's a whole bunch of rules, which is, so mostly Section 409A. If you give equity in the money, you don't have accounting problems. I mean, you do have accounting problems, but you have even bigger tax problems. And so you do not want to do that. So companies get valuations to prove that they didn't give it in the money, or else there's a 409A boogeyman that's going to create all sorts of tax headaches. But that's outside the scope of this.
Are those stocks protected against dilution?
Are they protected against dilution? No, they're not protected against. It's just stock, right?
So if you promise me to give me 25 stocks in 5 years, and like 3 years down the line, you see a triple split, I still get.
Oh, well, that kind of thing is a legal question, which is a function of how your plan works. I mean, you can't say to somebody, here, I'm going to give you a share of stock, but before I actually issue it to you, I'm going to dilute you to nothing. I mean, that's a legal question. So,
Are we creating money? I mean, when we create the stock, we maybe get a deduction. I mean, there's the deduction for the reporting you gain. And are we creating money?
well, we'll come back to that question at the very end of class, because I'm going to pull back up the Amazon 10K, and I want to explain to you how the economics of the back end of options work.
Okay.
Amanda?
Says the employees are subject to tax and investment fees, not when they sell. So that means also on the same vesting date, the company recognizes the expense.
They recognize a deduction,
But then,
the tax deduction.
so between the vesting and the sell, the price of Scholes is what, what was that? A stock? How does the company get any benefit from that?
So if I give Gamma stock today that's worth, well, if I give him an RSU when the stock today is worth 10, and Books is going to say, well, I guess I have to expense 10. And so say that he has to work for 2 years to get that stock. So I'm going to expense 5 in year 1, 5 in year 2. If the stock goes to $43, Gamma's like, this is awesome, right? When he gets the stock from me, he has $43 of income on his W-2, and he has to pay tax. I get a $43 deduction. That's that's wage income to him, the whole thing. It's a corporate deduction to me, the whole thing. But Books only ever expense 10.
Wow.
Okay? If the stock goes to 1, then Gamma has $1 of wage income. I get $1 of deduction, and the Books expensed 10.
So the book expense at grant date then?
The Books expense is determined at the grant date, both for options and for stock. It's just a question of how you determine it, not really at what date you determine it. Okay?
What a cool
You guys are like more interested when we don't talk about tax. I kind of figured out the concept here.
But I thought you said the tax deduction is at the time of exercise.
The tax deduction is at the time of exercise for an option or at the vest and issuance for an RSU or RSA. So it's at the realization event. I mean, when an employee picks up income, a company gets the deduction. There's matching there. Okay?
That's wild. You get deduction for taxes and you don't have to show it on the books. It's like the best of all worlds.
Maybe. Well,
It's like the depletion. Here's a deduction, but we don't have to. But it's not a real deduction for books.
you don't hear that phrase every day. It's like depletion.
Pardon?
I said you don't hear that every day. It's like depletion.
Well, it is.
Okay, so tax accounting for restricted stocks and RSUs. Okay, so now we're going to take all that fun about the types of instruments that exist, and we're going to talk about, well, how do we account for them? Okay. So for restricted stock and RSUs, like in the example I just covered with Gamma, I'm going to expense the value of the stock on the date that I grant it. Right? $10 in that example. And I'm going to expense it over whatever the vesting period is. Okay? The tax accounting for restricted stock works just like NSOs, and we're going to get into this in a minute. But basically what you do is you say, look, books expense 10. It's only a matter of time before I get a deduction. And I'm just going to assume that my future deduction is also 10. Okay? So why would you assume that? You think you're going to get a future deduction of 10?
Maybe somewhat different, but you don't know what it's going to be.
Yeah, you have no idea, right? So why? Why is because that's what the rules say to do, right? They just say the assumption is your future tax deduction will be the same amount that you expensed and recognized in your financial statements as a book expense. And then when the day of reckoning comes in the future, we'll true it up. Okay, and we'll deal with that true up a little bit later. But when you saw that deferred tax asset in Amazon's financial statements, that deferred tax asset was saying, I expensed my 10 when I gave awards to Gamma, but I haven't gotten my deduction yet. But I'm anticipating it. So there's been a whole bunch of book expense go through the financial statements, and I'm expecting in the future that I'm going to get a big tax deduction because it's only a matter of time. But that number, that's a book expense number that's just been bubbling up and accumulating. So if you said, am I really going to get a deduction for that? Like, no way. I mean, that number is completely understated for Amazon because the stock is way higher than it used to be. Right? So that number is this weird accounting concept that's really hard to put any kind of fair value like logic against. Okay?
Why don't they just update the number annually?
Because that would be different from GAAP. That's how IFRS works. I mean, they have more of a mark-to-market approach. But let's say Amazon stock went to $1, they would still show that deferred asset because the accounting theory is I leave the book expense in there as an expected future tax deduction until I know better. It's very academic. It's not fair value or real world-ish. Okay. So overview, 4 bullets. Okay, this is key, and we're going to go through slide. I'm going to break down each of these bullets into its own slide in a minute, because this is where we need to go slow and steady. Okay, first bullet. So if you can get these 4 things straight in your head tonight, we can just not have class next week. Okay, the first bullet. You record an expected tax benefit for most awards when the book expense is recognized. So for most awards, NSOs and RSUs, when you look at the population of a company's stock compensation arrangements, those 2 things will be the vast majority. I'm going to get like a counter. Every time you guys yawn, I'm like, count.
How can you yawn when you're listening to this?
I know, this is so exciting, right?
No, I'm just
You guys are funny. There's a
There's
high yawn rate tonight.
I was thinking about it,
I've got the Red Bull in my car. I didn't bring it with me this time.
Who would you give it to?
I was telling, I gave it to Mike last time. Mostly because he has the biggest smile, not because he looked the sleepiest, though. Anyways, okay, so record the expected benefits when most awards, when the book expense is recognized. Okay, so I issue an option or an RSU, books expenses it. Okay, so often people refer to this as like year one. Year one is the expense. Okay, you got to earn it. You got to vest. So when books expenses it, the entry that books is going to record for the expense is going to be debit expense 100, credit APIC 100. That is their journal entry to give you something in the form of stock compensation. So when you look at their P&L, you'll see a line for stock expense, or it'll be buried in the other expense lines. When you look at the equity roll forward, you'll see credits to APIC because they'll be issuing stock awards. Okay? This is what the book guys do while you're earning your stock compensation. Okay, so this is over the period you earn it. Let's just say it's a year, so this is year one. Okay? Year one. Okay, so that's the book entry. So the tax entry, to basically follow through on what this bullet said, is you need to book the tax benefit for most awards when the expense is recognized. So we're going to say debit DTA for 35, credit provision for 35. So we're going to say, hey, I had that $100 of book P&L. I expect that to yield a tax benefit, so my net income changes only by $65. Just like any dollar of expense, right? The same would be true if this was just cash wages. And now I'm sitting here with my DTA and thinking, I hope that I get a $35 tax benefit someday. Okay?
I understand this, but what I'm getting confused is what if the employee doesn't fully vest? Do you reverse this entry out, or
That's complicated. So, well, what happens is forfeiture rates get built into these calculations. So every time somebody gets an award, they don't give it full value based on everyone staying at the company. It's all baked into the math. So all this gets based on expected employee turnover, and that's just pervasive throughout the calcs. And then there's all these true-up mechanisms. So it's a little hard to see that option by option. Yeah, that's tricky.
Like a built-in valuation.
Okay. But if we just stick to this bullet, year one, books expenses something, we set up a DTA anticipating a benefit. Okay? If this is an ISO, what do we do in that second part of the entry? Linda? You're shaking your head for, you don't know. You mean you book nothing, right? Right. So you don't set up a DTA if it's an ISO or ESPP because you're not assured of a tax deduction. So you can't set up a DTA and expect that benefit if you don't know the benefit's coming just by virtue of applying tax law, right? Because if people met the holding period requirements, you wouldn't get a deduction. Patty?
They don't say being actuarial or whatever, don't.
There's no guessing. No, the way the rules work is if you are assured a deduction, you set up a DTA. If you're not assured a deduction, you don't set up a DTA. We'll explain this a little more in an example in a bit here. Grant?
I'm just having a problem with my double entry bookkeeping here. So in credit provision, crediting the expense account?
Crediting expense account. You're saying that book expense of 100 has a provision benefit of 35.
I wish you'd call it income. I think an income provision bugs me. I don't think
Noted.
Pardon?
Noted.
You all know what provision is? I know what income is. I don't know what provision is. You laugh.
Well, the line is called tax provision, so we're going to want to work on that. Patty?
Yeah, the provision expense is credit, so
Right, but let's just say you lost $100. Forget stock comp. You lose them $100, and you can carry that loss back and refund your taxes for the prior year. You would book debit receivable because the government's going to send me some money. Credit provision, right? Tax is a source of income.
Yeah.
Every dollar of expense that goes through the financial statements creates a credit to tax provision. That's how it works. Every expense that hits your financial statements, it saves you tax. That creates benefits. It just happens to be netting with revenue.
We create
Said best from an FTB agent. Not every expense, right?
not every expense.
Mike.
You said it's not for ISOs and what else?
ESPPs. And we're really just living in a U.S. world right now. I mean, in a foreign, like Grant was saying like a half hour ago, this could be the same for foreign too.
When you're crediting the APEC through the increasing the equity of the company, are we essentially taking stock and making it outstanding stock?
Yeah.
Are we going from authorized to outstanding?
Yeah, this first entry is us just issuing stock, right? If you just said, you know what, we're going to go public, we're going to issue stock, it would be the same entry, except instead of expensing the debit, you would be just putting cash in there. But you're issuing equity. Right. Okay, so that's bullet 1. Okay? Bullet 2. Reconcile the expected tax benefits to the actual tax savings when the deduction is allowed. Okay, so we said earlier in our example that we expect a deduction of 100. Okay? Our actual deduction, well, it might be 90. Well, it might be 110. Right? And we need to figure out what that difference is going to be.
So we true it up.
We true it up, right? So if it's 90, we're going to debit our tax payable for 31.5. We need to credit our DTA for 35. The DTA's got to go away. And we need to do something with the difference. Right? We'll get to that in a future slide. But in our first slide we said we need to anticipate the benefit. Now we're going to get the benefit, but it's going to be a different number, and we got to start thinking about how we're going to deal with this. Okay? If the actual tax savings are greater than expected, so this is our 110 example, right? If they're greater than expected, the excess goes to APIC. So I'm going to debit my payable for 110 times 35%. Debit payable 38.5. Credit my DTA for, not a trick question, 35. I will credit APIC for 3.5. Okay. If the savings are less than I expected, well, this gets tricky. So I'm going to debit my payable for 31.5. I'm going to credit my DTA for 35. And my balancing debit for 3.5, that's kind of an unknown. So it could be APIC, just like the credit goes to APIC. But you can only debit APIC if you've built up other credits to APIC for the same sort of thing before. So let's say this is the first option or first RSU you've ever given. You've never given another one, and this happens. That debit goes to P&L. Okay? If you had 2 awards, and the first one looked like this, and you credited APIC, and the second one looked like that, you would debit APIC. Because you've already credited APIC before, so you can just kind of earn out that old APIC credit. That's what they call your APIC pool. So if this is making sense, you're thinking, I want me a big pool, right? Because every time the stock goes down, you don't want to be writing off your DTAs to your provision. That's not fun. All right, your CFO is going to get tired of that fast. All right. Okay, so that's our key 4 slides. Anticipate a benefit if it's an NSO or RSU. Reconcile the expected benefit with what actually happens, and then bookkeep for excesses or shortfalls. Okay, we're going to go through this again and again, so if you don't get it this time, not to worry. Okay, so I'm going to hit pause and reset the video, okay?